Germany is facing a ticking time bomb when it comes to its pension system. And the government's latest idea, a modest €10 monthly subsidy for parents to invest in their children's financial future, has sparked heated debate. At first glance, this initiative might seem like a small step, but it raises big questions. Can such a minor incentive truly transform how everyday Germans think about investing? And more importantly, is it enough to address the looming crisis threatening the nation's retirement security? Friedrich Merz, Germany's chancellor, recently took to YouTube to urge young people not to depend solely on public pensions. Instead, he encouraged them to embrace the stock market by regularly setting aside small amounts of money. His comments ignited a firestorm of criticism from powerful labor unions, particularly IG Metall, which labeled his stance as out of touch and potentially harmful. Rather than promoting private investments, they argued, Merz should focus on shoring up the country's struggling pay-as-you-go pension system, a model that has endured wars and economic upheavals since its creation in 1889 under Otto von Bismarck. But here's where it gets controversial. The demographic shifts underway in Germany paint a dire picture. According to projections by the Cologne Institute for Economic Research, IW, by 2036, nearly 19.5 million baby boomers will have retired, leaving only 12.5 million younger workers to fill their shoes. This imbalance means that by 2040, every 100 workers will need to support 41 retirees, compared to just 30 today. With fewer contributors and more beneficiaries, the strain on the pension system is undeniable. Merz's coalition government isn't proposing a radical overhaul of the state-run pension scheme. Instead, they're nudging households toward what they call individual, capital-backed, and privately managed retirement savings accounts. These would serve as a supplement to traditional pensions. One key plank of this strategy is the new €10 monthly subsidy program aimed at children aged 6 to 18. Starting next year, parents can use these funds to open share-based savings plans for their kids, with the stipulation that the money remains untouched until retirement age. Germany's pension predicament serves as a cautionary tale for other European Union countries. On average, EU member states already allocate 12% of their GDP to public pension schemes, and many are grappling with similar demographic challenges. Merz's push mirrors efforts elsewhere, including the US and UK, to steer retirement savings into productive assets like infrastructure, real estate, and private equity. In Germany, however, the stakes feel especially high. Each year, roughly a quarter of the federal budget, amounting to €117.9 billion in 2024, is funneled into patching holes in the pension system. Without significant reforms, this burden is expected to grow even heavier, according to warnings from the Federal Audit Office. Meanwhile, the German Council of Economic Experts predicts that pension benefits may decline, while contribution rates could soar under current policies. Despite these alarming trends, Germans remain hesitant to dive into the world of investing. Only 17% of adults in Germany own stocks, investment funds, or exchange-traded funds (ETFs). Compare that to 39% in the UK and a staggering 62% in the US. This reluctance stems partly from decades of government assurances that the state pension system is rock solid. Andreas Hackethal, a finance professor at Frankfurt University, notes that this long-standing promise has created a culture of dependency on public pensions. The €10 per month initiative, nicknamed the Early Start Pension, is still in its conceptual stages, though officials stress its importance. Carsten Linnemann, General Secretary of Merz's Christian Democratic Union (CDU) party, explained that the goal is twofold: introducing young people to the capital markets early and helping alleviate the growing pension gap over time. The annual cost of the subsidy is projected to be around €1.5 billion. According to estimates from the Council of Economic Experts, one of the masterminds behind this plan is Ulrike Malmendier, a behavioral finance expert and member of the Council of Economic Experts. She argues that investing in a diversified portfolio over a 30-year horizon virtually guarantees respectable returns. While academic studies back her claims, Malmendier acknowledges that many Germans simply haven't grasped this concept yet. As a professor, I can explain it theoretically, she says, but there's no substitute for first-hand experience. Currently, German households collectively hold €9 trillion in financial assets, with a whopping 37% parked in cash or low-interest bank deposits, per Bundesbank data. A survey conducted in May revealed that nearly half of Germans prioritize minimizing risk when investing, while only 14% seek high returns. Yet experts like Christian Hecker, founder of online broker Trade Republic, insist that achieving annual returns of 6 to 8% is crucial to closing the pension gap. Assuming an average annual return of 7%, the €10 monthly subsidy could accumulate to approximately €2,200 by the time a child turns 18. Left untouched for another 50 years, this sum could balloon to €65,000 on paper. However, Ali Misarwa, CEO of wealth advisory firm Envestor, cautions that inflation could erode 2/3 of its real value. When you look at the numbers, the early start pension feels more symbolic than substantive, he remarks. Proponents of the plan, including Malmendier, believe its true value lies in fostering behavioral change. If children and their parents become more comfortable with investing, they might eventually channel additional funds into higher return opportunities. Experiencing the power of compounding firsthand can shape someone's financial habits for life. Malmendier observes, however, history offers sobering lessons. Previous attempts to incentivize private pensions in Germany have fallen flat. For instance, Gerhard Schroeder's administration introduced tax breaks for capital-backed pensions in 2002 through the so-called Riester pension. Unfortunately, rigid regulations forced asset managers to guarantee specific payout levels, leading to costly risk management strategies and products that were often lackluster and overpriced. Government figures suggest that up to a quarter of the 15 million policies sold have been abandoned. Olaf Scholz, Merz's predecessor, attempted to rectify these issues. Last September, then Finance Minister Christian Lindner unveiled what some hailed as a bold proposal to revamp private pensions. But before the plan could take effect, the government collapsed. Now, Malmendier is urging mayors to seize the opportunity to get it right this time. We messed up with Riester,